Hello, everyone. My name is Manolis Finorilakis, the founder and creator of Reality Crowd TV, and welcome to the 5th episode of Reality Crowd TV's Crowdfunding Hangouts. I'm here with my co-host, Jessica Sun, and we also have a great panel here tonight, and the topic for tonight is going to be Title III equity crowdfunding and the liquidity concerns that currently are out there in the industry. And I'd like to introduce my panelists one by one, and I'll each give them a little bit of time to briefly introduce themselves before we go into the actual show segment. But let me introduce everyone first. We have Kendall Almerico, who is the founder and CEO of FundHub. We have Dusty L.W. Brogdon, who is the founder and CFO of IncuBanker. And we have Adam Pressman, the National Executive Officer of Crowdfund Roundup. And what we'll do is we will actually now give it over to Adam Pressman, and Adam Pressman will actually introduce himself. Jessica Sun. And we also have a great panel here tonight.
Thank you very much, Manolis. Yes, as I said, my name is Adam Pressman, and why am I here? Well, like Reality Crowd TV, we at Crowdfund Roundup find the biggest challenge to the goal of the Jobs Act and the promise of crowdfunding is education. The show will serve in a global broadcast approach what my CR does at the community level, one-to-one with business betterment professionals who know the community, have references, and are trusted there. The next biggest challenge is the perception of startup investing and how to reduce risk so that more people will invest, more will court investors that they know and care about, and this will bring more investor dollars, which will create more wealth and more opportunity in those communities.
Excellent. Thank you, Adam, for that introduction.
Thank you.
And our next panelist is Dusty Brogdon. And Dusty, please give yourself a brief introduction as well of what you do and a little introduction.
Yeah, Manless, I have been tackling the equity liquidity platform and the issues that we may have involved with that. For instance, when you make an investment in a crowdfunding business, what do you do then? What's next? So the secondary market is where this approach would be focused in what we're doing. So we have developed IncuBanker.com as an example, and just recently CFBulletinBoard.com to give you an idea. It's an example of the OTC bulletin board, or over-the-counter trading board.
Excellent. Thank you, Dusty. And then our third panelist is Kendall Almerico from FundHub. And Kendall, please give yourself a brief introduction.
Sure, Manolis, and with a name like yours, I'm sure that you're used to people mispronouncing your name. It's actually pronounced Almerico, and for the last 50 years, I've had to correct every single person who's ever introduced me, so don't worry about it. But I'm the most mispronounced name in all of crowdfunding. But just call me Kendall, and we won't have any problems. But FundHub is the newest. I've been involved in the crowdfunding industry for a couple of years now. I've run and still do run a rewards-based crowdfunding portal called ClickStartMe. We have a charity crowdfunding site called Crowd It Forward, where we do random acts of crowdfunding to keep good news stories in the news. But most recently, because of the Title III, and my real interest as a lawyer and a person who's practiced in the world of helping people start businesses, has always been to help people get funding for their businesses. At FundHub, we're not a crowdfunding portal. We do all the compliance and all of the stuff that needs to be done for crowdfunding portals and broker-dealers and regulation and D-raises and issuers and investors to make sure that the 585 pages that the SEC put out last year get complied with, so nobody goes to jail, gets sued, ends up in bad news. That's what FundHub is all about. So everyone involved in the whole crowdfunding spectrum has a place to go to get the legal compliance stuff done without paying a law firm exorbitant fees to do it.
Excellent, excellent. That is a very important service. So thank you for that. So, all right. So let's actually step right into this. And Jess, I know the show, so I'm actually going to just start the conversation, but I'd like you to just jump in and stop me because I don't like hogging the show. So I'll let you jump in whenever you're ready, Jess. Let me I'll start off with Dusty because I spoke to him briefly on exactly this topic. And for those viewers who do not know what Title III equity crowdfunding is, it is actually the introduction of investment-based crowdfunding to unaccredited investors, meaning investors, regardless of income, will soon be able to be investing in private companies through the crowdfunding model. So if you take the Kickstarter model, which is for a donation, you receive a reward. What's happening in America right now, the rules are being finalized as we speak in the SEC. If you take the donation and you get a reward model, now you're making a contribution, and Title III crowdfunding is allowing people to either purchase a share in a private company or actually loan a company debt in the form of a bond and earn a return as the so-called reward in the equation. So what we're specifically talking about tonight, however, is what happens after an actual transaction is made where someone actually purchases a share or someone actually loans money. What happens after the fact? Can they hold it on for a certain period of time? Can they freely exchange these securities after they purchase them? And what Dusty is working on right now is a way to solve a really big problem in the regulations. And so, as it stands right now, I'll let Dusty first identify what the problem is in the regulations, and then I'll also let Dusty tell us about IncuBanker and what he's working on to try to solve that problem. So, Dusty, please go ahead.
Okay, thank you. Excuse me. In order to simplify the process, let's just start with 4 key points. Let's say we have a business. It could be a widget company. So as a consumer or an investor, we would, as an investor, we would look at these ideas. First, the idea, is it scalable? Second, the people involved, the staff. And third, the valuation of the business. Was it really valued at what we think we can actually invest in and make a profit at or a return on our investment? Of course, along with that would be the dilution and also the transparency of the offer. What I feel that has not been addressed publicly is the liquidity or exit strategies for these equity purchases. So far, the rules say we would hold these investments for 1 year. It is designed to eliminate the pump and dump concepts. But if we don't have an exit strategy, it would be very difficult to dump a stock. So the secondary trading market, such as Facebook and Twitter, what they did when they were private is they used a secondary trading platform, mostly shares post. And this would enable the people who were interested in obtaining shares of stock the ability to go in and to make that trade with holders of the stock. And also, so that was your liquidation process. When they went public, then that's who that was the initial stock that was offered on the float for the loan. So now as an investor, I was able to get into this business pre-IPO before it went public, purchase shares. Now maybe I received them at 3 cents a share. When it went open on the public, the day it opened up, my valuations would increase depending on the price of the stock. What we're proposed to do is to allow businesses to fill the forms out that they would in an initial public offering, the forms 3, 4, and 5, the 10K reporting forms, and even some simplified S1 form. All businesses have risk factors. It doesn't matter if you're General Motors or Bank of America. A standardized concept of most businesses fail, and your investment is very risky, I think would be a blanket policy. But the creation of a website that would have the total transparency of the numbers of shares out, the shareholders, and all of the transfers of shares would be what we're focusing on, to allow the investors to know where they are in the process once they get inside the widget company.
Wonderful, wonderful. Okay, so just so I can make sure that I understood that too. So you said that once Title III equity crowdfunding is finalized, the current rules that are in place essentially state that once you purchase a security, whether you buy a share in this company that's posting their business online for funding, or whether you loan them debt, you have to hold that security for at least a year. And is that correct? Is that what?
That's the way. Yes, that's the way it's currently written. Hold it for 1 year, and then you would have the exit strategy or liquidation would be to return it back to the issuer. And I just don't believe that that's going to help crowdfunding equity at all.
Okay, very good. So just to confirm that understanding, I know Kendall Almarico is a crowdfunding expert. And Kendall, is that your assessment of the law as well as it currently stands?
Well, there is no law right now on it. There are proposed rules from the SEC. And these proposed rules say that you have to hold the stock for a year based upon what the Jobs Act Title III says. What happens after that, we don't know. I think it could be inferred from the rules, what Dusty said, that after a year is over, these shares, this debt could be tradable at that point, depending on if the company, the ones who issued the stocks, put that as part of their stock issue at the beginning. This is, whenever someone does a private issue of stock in the finance world, it's the most mysterious process in the world. Most people don't have any idea how it works, but you have a great deal of control over what you can do. You can say, for example, as Dusty pointed out, well, these shares can be diluted. And how can they be diluted? You can have provisions for the company to buy the shares back. You can have provisions that after a period of time, the shares are tradable in certain ways. It all depends on those issuers, the companies who issue the stock, when they do it, deciding what they want to do with those shares. Because many, many times with a standard Regulation D offering, the way people raise money, almost $1 trillion last year in the private equity market, the shares are never tradable. They're never tradable in a lot of cases. They're literally written into the offering documents that these are not going to be publicly tradable unless there's some type of a conversion of that. So it really is going to depend, and that's why I'm interested to hear what Dusty has to say. This is all about educating the public again and making sure that they understand and that people are advising them well when they go to these equity crowdfunding portals to know that you have to, at the beginning when you issue this stock, create a system where you're explaining to the investors what's going to happen with that stock down the line. If you don't put it in there, if you don't say they're going to be tradable after a year, there's a good chance they won't be.
Very good point. That's a very good point. So it is stipulated within the actual offering documents if they can be traded in the first place in the traditional way, the private equity markets. Now, it'll be interesting to see what happens with Title III equity crowdfunding, because as you did mention, they are proposed rules.
Sure.
The comment period on these rules stopped on February 3rd, but now they're trying to incorporate all the comments that came in so that they can finalize the rules so that it could actually be workable. Now, Adam, I'm going to get to you in a moment because you have a very interesting twist to this. You actually are creating a product that's going to be used to entice companies and add assurance to the actual raise of certain crowdfunders. But before we go there, Adam, I'd like to just go back to Dusty because I'd like him to explain what his proposed solution is to the current liquidity concerns that the proposed rules currently have. So, Dusty, did you want me to share my screen, or are you actually? Let me share my screen because I believe you have a mock website set up as to what your proposal is. Is that correct?
Yeah, that's correct. We just recently put together CF Bulletin Board, which would be a similar replication. We're not really proposing to reinvent the wheel, but more so just take the secondary trading platform concepts that are there and maybe even break these offerings in two parts. One would be a little more advanced with the documents filled out and filed and on the website for companies that wish to participate in a more advanced opportunity, which would then allow them to trade their equities, exchange them through an ATS.
Excuse me for one moment, Dusty. Just so I could see, is everyone seeing my screen at the moment?
Yep.
So whenever Dusty's talking, you're seeing my screen or no?
I can see. Yeah, I can see your screen.
Okay, perfect. So Dusty, just lead me through where you want to show us your actual.
That would be good. To the top right-hand corner, we have the CF symbol directory. This is a very basic demonstration site here. If you would go ahead and click the symbol, that would take you in. Of course, this information is for demonstration purposes only. These portals are considered everyone has to go through a FINRA-approved crowdfunding. So at the very top, we will take the first gray box of the 6 gray boxes. We'll take the let's take the one at the top in the middle, which is Internet Business Trader. To the right of that, The CrowdOps would be the FINRA-approved crowdfunding platform. This would take you into a site that would give you all of the information that you would need to know with how many shares the company has issued, how many are outstanding, and then the shareholders. So if you go to the left of the screen right here where the shareholders say, and you would put that's about 5 down from there, right there, click that. And that will take you to a page where you can access the forms 3, 4, and 5. Every time you purchase a stock, you fill out a form. When you sell a stock, you fill out a form. And insiders also fill out a specific form. Most of these opportunities will be with insider trades, so that's very important. As you scroll to the bottom of the page, it gives you a complete breakdown of the insider trades. So every shareholder in this business is listed, the amounts of shares that they have, the price that they were bought in at, and also the date that they were purchased. So you can make an accounting for all of the value of the company. So really all I have to do now is to look at the company, look at their business plan, do an S1 form. I know that there's risk involved in all of these investments. That goes without saying. And then find out who really works for the company, going back to the people involved. Does this make sense? Do they have a scalable idea on their S1 registration form, or do they plan to maybe go public in the next year or two? And do I believe that the valuation of this business and investment, it has a real purpose, possibly to be an investment?
Very interesting. Okay, so you're proposing that through this type of an alternative trading system, I believe you mentioned to me that there is actually currently one called sharepost.com for these accredited investor private equity deals.
Correct. SharesPost is one, and Second Market, two of the larger secondary trading platforms that are mentioned. They handle Facebook, Twitter, Yelp, the big companies that we're familiar with.
Very interesting. So who are currently seeking, well, rather not currently, because again, it's just the proposed rules in Title III equity. But when these rules become finalized, what you're proposing they would do is they would come to a site like yours. They would be willing to actually have all the transparency up front so that they have all the insiders, all the share information. And then when they actually decide to raise money through this Title III equity crowdfunding, at that point is where you would say that any further transactions would also be tracked and recorded on this alternative trading platform?
Yes, let's look at it as 3 parties. We have the company, we have the investor, and then we would have the third party, which would handle the process, which would document, fill out the forms, put them online where everyone could see them, and then actually a 5th party that would actually come in and process the transactions. Right now, if you were to purchase stock in a private equity company through a SharesPost, an alternative trading system, you would have an attorney or someone that would, and they would have a broker's license, so they can legally sell you stock. We're not going to be that complicated. You'll be able to come in and read these same documents that you would on a public offering, except they're not going to be as critical as what it would be, and costly to put together as what it would be on a public offering.
Very interesting, and I actually want to bring Adam Pressman in on this just so that we can get his opinion on this endeavor that you're trying to work on, Dusty. So Adam, what is your opinion on what you just saw, that little demonstration?
Thanks, Manolis, and thank you, Dusty, for a great explanation. And as Kendall had said, it really is all about educating and providing a sense of transparency to the process. When we started with the method of risk reduction I'm going to share with you in a minute, we were focused on the reality that less than 10% of accredited investors, now I know in this episode we're talking about the unaccredited ones, but the sophisticated, accustomed to investing high net wealth individual or married couple, only fewer than 10% of them are engaged in startup investing. And we tried to look at why, and the reason is they can lose their principal. Everybody understands that startup investing is risky. And once upon a time, cars didn't come with seatbelts and airbags and were frankly pretty dangerous. And technology that the industry created and some that the government required, a public-private partnership, was put together to reduce risk in automotive and in every other form of travel. what I like to call our product called CR Cover, or Crowdfund Roundup Cover, is an airbag for the crowdfund industry. We guarantee that an investor in a crowdfunding venture will not lose their principal. It's very simple. It uses the insurance model. Nothing magic about it. We simply take a portion of the raise, invest it just like an insurance company would. That investment gains enough value that should the venture itself fail, we're able to give back the principal. The reason we did this was because of exactly what Dusty and Kendall have been saying. Without a transparent process, with a lot of moving parts, with the joining together of what used to be a relatively closed way of maintaining capital and the relative openness of the internet, there's going to be a whole lot of confusion out there. What makes people feel better about a process they don't understand is that they can get insurance. For example, they may not know what may go wrong with their bodies over the next year, but they know with their health care insurance they're protected. We seek to do the same thing to empower a larger investment that way. And the other side of this is, from the liquidity perspective, we have been counseling not as necessary to replace equity crowdfunding, and in fact you've already brought up as it's also still securities as opposed to rewards crowdfunding, but a royalty, a revenue royalty loan is one way that the unsophisticated investor quickly gets a handle on exactly what he's going to get for his money, when he's going to get it, what circumstances under which he might lose it, and we would therefore have to pay up as his insurance agent, and what options are out there for the fundraiser to control his exposure to property dilution. You know, Kendall and Dusty made that point, as well as what they're going to do in later rounds of funding. How complicated is that going to be with different levels of equity in there? With a royalty loan, and sometimes it's simpler. Like I said, not trying to rule out equity crowdfunding, but royalty crowdfunding doesn't get the shake it deserves for a lot of startups. Hopefully that answers your question.
Yes. Actually, you have an interesting piece to this, which it sounds like your CR Cover product is focusing in on how to get people to actually want to invest in these Title III offerings. Now, what I'll do is I would actually like to get Kendall in on this to comment on both. And Kendall, just let me summarize what Adam mentioned. And Adam, you could correct me if I'm wrong. But Adam is creating a product where on top of a raise, let's say a company is trying to raise $30,000, and they're having a hard time getting investors to feel confident in raising equity on Title III investments. What they might do is they might go to Adam and Crowdfund Roundup, and they might try to purchase this, or not purchase, they might incorporate this product that he has called the CR Cover. And what essentially that does is the raise, instead of $30,000 for the raise in Title III equity crowdfunding, they're raising $60,000, and with that extra $30,000, that is the insurance that if the company who's raising money in Title III equity crowdfunding eventually fails, they still purchased an additional asset for $30,000, which then they could liquidate down in a period of time. It's almost insurance for their investment. And now what Dusty mentioned is Dusty's trying to take the already established model of sharepost.com, and that is currently being used for private equity and private placement deals, and he's trying to incorporate that same concept to Title III equity. Now, Kendall, based on your experiences, can you comment on both, and what is your opinion on both of those scenarios?
Well, sure. I think that I'm really interested in what Adam is doing from this perspective. You know, my new business, Fund Hub, was born out of the fact that when these rules came out in October, they were so complicated and so difficult for the general public to understand that it almost seems that no one's going to be able to use equity crowdfunding because they're not going to understand it even when it becomes legal. You know, people are just not going to get it. And what's happened is there's been a number of people out there that realize this and are creating businesses around that complication, that difficulty. And Adam has hit on a very good point. If you can insure your investment, and I don't necessarily want to use the word insure, which may not be the correct word, but if you can have some basic understanding that the money that you're putting into something, you're going to get it back no matter what, and maybe pay some type of a premium for that, or the company pays some type of a premium for that. That's a very ingenious way of getting people to use this model that most people out there hadn't thought of, and I think it's potentially a very good thing to do. Like any other insurance type product, it all depends. I mean, obviously Adam is a very bright guy, and I'm sure will price it appropriately so that it's not something, I mean, you know, if I was going to buy $1,000 of stock and to buy the insurance on it, it's going to cost me $800. I'm not going to do it. You know, it just goes without saying. But if it's an appropriately priced model and it provides protections for people, I think it's a great thing that will definitely spur on a lot of investment. And, you know, from the standpoint of what Dusty's doing, absolutely. I mean, there are the concept of the secondary markets that are going to come out of equity crowdfunding and Title III raises is a wild, wild west right now, because nobody knows what's going to happen. You're going to have a lot of attorneys and a lot of broker-dealers advising people not to make their stock tradable, to keep it privately held, because the goal here is to get to the next raise, and you know, that next round that comes in, those people aren't going to want to have 100,000 people that they don't know running around trading the stock publicly. So it's a very interesting concept, and you know, educating once again people to look at what's going to happen. You know, investors want to know, where's my money going and how do I get out? And how do I get out is a very, very important question in the equity crowdfunding world. Right now, all we know is you can't get out for a year. What happens after that? We're all going to find out, and I'm really interested to see what it is that Dusty comes up with, because that could be a very, very important marketplace that occurs, you know, down the line.
Absolutely, very, very good points, Kendall, and very thoughtful responses. So, I actually like what Adam is doing. I like what Dusty is doing.
May I add something here?
Yes, you may. Go right ahead, Dusty.
I think it's a great idea, Adam, that you would be able to guarantee all investments. That may be a stretch. How it would be regulated would probably be the big stickling point. But what I would say is an insurance opportunity, where I would be assured as an investor that if there were any type of corruption or any law breaking with the forms, that my investment would be covered. Like the Madoff scam, FINRA basically covered the investors that were taken from that. And the same thing against any type of fraudulent documents. So I think that would be probably a little more practical, maybe even a little bit easier to get through first to get a business model set up. That if these people were in again in criminal activity to make these documents just up artificially, that my investment would be covered. Of course, there'd be a lot to be proven with that. It would be time consuming. So, but I think it's a great idea if I could be guaranteed the cover of my investment. But you'd think that the percentage of the investment would outweigh or override the percentage of equity that I could pull off my investment. If it cost me 20% to insure that investment, and the most I could make out of it would be maybe 10 or 15%, of course I'd be in a, it's a great idea. I just hope that, that it wouldn't be too costly.
And Adam, I can give you a chance to respond to that as far as the cost is concerned. Would you like to say something about that?
Yes, thank you. Obviously, the prospect of a 50% premium is something that a very sophisticated angel or individual investor or venture capital house simply wouldn't do. And we understand that. Our model is designed to meet a very specific requirement, which is the crowdfund investor with a $250 a shot to maybe $5,000 an entry point. Here's a guy who doesn't have access to the kinds of assets we're talking about, and we aggregate those assets so that he can. The way we couch the premium is that it is usually in a royalty deal, because the other kind hasn't been legal to do up until now. And this body of law goes back to the 40s at the loan clubs. And every mine drilled, every ship, set sail is a royalty loan in a way. So there's nothing new or magic here. It just hasn't been accessible before. And what we found is, gave Manolis an example earlier, we had a 62% ROI year over year for a particular aircraft lighting manufacturer in our projection. And when we applied the insurance, it was a 24% ROI. So here's somebody looking at an investment. 7 years, he's going to get 24% each year if the performance work out as they should. And there's no risk of loss, where the typical investor who doesn't have that coverage would be at 62% ROI if all goes well, but a full risk of loss. And we slide in between. And our significant competitor out there, who hasn't really released an offering, but I've spoken to them about it, does exactly what Dusty was alluding to. When FINRA certifies an abuse or a bankruptcy or something that is something for which the insurance can already be bought, then yes, that company will pay. I don't want crowd investors to have to worry about the hoops they may have to go through. I don't care what the reason is. It doesn't matter to me why something didn't happen. If the milestones don't get met, we pay.
Very interesting. I like that, Adam. And as proposed rules become finalized, and as as Crowdfund Roundup is able to actually use that model to actually successfully raise funds and then also protect investors, I think you guys have a great business model. So just to go back to Dusty for a moment. Welcome. Yep. Just to go back to Dusty for a moment. With what you're doing, Dusty, are you open to other people coming in to help you? Where are you on your actual project? What are you needing right now as far as trying to get your idea to a broader audience? Because if your idea can be solidified and become the standard and somehow be workable within the regulations, because the proposed rules may actually stop any kind of attempt to do something like this. So are you working within the proposed rules, or are you looking further down the line when the SEC may have to change their regulations in order to make this a more workable framework?
Well, that's a good question. Looking over the 680-page document, the only thing on the exit strategy that really comes up is the hold for 1 year and return to issuer. I don't believe there will be any success in this Title III equity if we don't have some means to exit our investment and to profit from our investment. So I just don't see anything happening. I would like to seek others that have an interest in this opportunity, anyone that's into this space. Again, without some liquidity opportunity or exit strategy, I just don't see any future in Title III at all.
That's interesting, because just to kind of catch up the audience. So, as the law currently stands, you have to hold these securities for 1 year, and I'm going to ask Kendall just to make sure that he's correcting what I say here. At present, you could either, at the end of the year, you could either sell it back to the company, you can either sell it to close relatives, or you can hold it, earn income off of the dividends if you bought a share, earn income off of the interest if you loan the company money, and an ultimate exit strategy could be either the company gets bought out by a larger company or the company actually goes public through an IPO. So Kendall, is that really what the exit strategies are currently? You can't freely sell it back and forth to someone you don't know yet, but you do have options to actually liquidate those shares or liquidate that debt if another company buys the company you invested in, or if the company eventually goes public, like a Twitter that recently did. It was a huge windfall for those type of companies. Is that accurate?
That's absolutely correct, Manolis. The important thing to note is, and again, this goes back to what I was talking about before, when a company decides to issue this crowdfunding Title III stock or debt to someone, they're going to set up a bunch of rules. It's going to be in their offering document or their disclosure documents that are given out, and they're going to say, here is how you can dispose of the stock. Here is the liquidity options you have after a year. Now, can the company buy the stock back? Absolutely. That's always a possibility. Is any company going to buy the stock back? Probably not, unless the company's doing phenomenally well, and the company is going for another round of financing and needs that stock back to be able to get that, or the company anticipates going public. But this is where the investors have to be very careful. You know, let's say, for example, that the offering document says, we're going to raise $500,000 or selling shares of stock in our company at $250 a piece. People need to read that offering document, because it may say, we reserve the right to buy those shares back totally in our option if we want to, 1 year and a day after it's purchased for $260. All right? They could write that in there. Now, all of us have read private placement memoranda and prospectuses and investor materials. Those of us who do this type of legal work see them all the time. Average investor, these aren't accredited investors. This is everybody on the street. This is anybody that wants to buy into this. They've never read one of these documents, and if they read one of these documents, they'd never buy anything, because the documents are 100 pages long, 90 of which are telling you why it's a bad investment, because that's how they cover their rears. So the bottom line is, you're going to have unsophisticated investors, which is great, crowdfunding something, but they're not necessarily going to know if they don't pay attention to what that liquidity is. And it may be that the company does gangbusters and then comes to them after a year and says, guess what, I'm going to buy your stock back and you're going to get 1% on it. And they're out of luck. So you need to read the offering documents, and these companies, one of the things that Title III is very clear about, it's one of the things at FundHub that we're doing when we prepare these documents for these companies, we have to educate. The companies have to educate. It's in the Title III rules. It's not only in Title III itself, but it's in the SEC proposed rules. There has to be sufficient educational materials given with the offering that people understand what they're doing. So I think where we're going to see some issues here is that people don't understand what they're buying and don't understand the liquidity and don't understand that they may not be able to sell it back. The company may put in their offering document, we're never going to buy this stock back, or we're going to buy it back for a very, very, very small vig over what you paid. It's very important that people pay attention to that.
Interesting. I actually, you make a very good point. In fact, maybe the way that Title III equity crowdfunding should be potentially marketed, if you're a business owner and you're looking to expand and you're looking at this potential form of funding, it seems to me that this is really a long-term play. Right now, there is no short-term liquidation. So if someone is going to want to sell the idea of Title III crowdfunding, then you're right, it's education, but it's also, this is a long-term investment plan, and if you're going to make a long-term investment, you need to do your research on it, because right now the mechanisms are very limited on how you could liquidate an investment in this manner. And also, if you are going to make an investment, you also may need to really assess what your budget is, because you need to allocate this form of an investment perhaps in a more risky asset class than you would in another investment. But what I see here as well is the opportunity for social entrepreneurship to really be one of the bigger players in this market. Because what I see here is not only are financials going to be important, but the companies that do well in Title III crowdfunding not only will have strong financials, but they'll also have a strong story to tell at the same time. And that story will be coupled with the education requirements, coupled with the fact that they're saying this is a long-term investment. We're trying to do something here that's good for society, but it's not going to take 1 year, 3 years, 5 years. It may take more than that. So, based on that, do the panelists agree that this might be more of a longer-term investment as the law currently stands? And I'll give that to Adam so that he can get a shot. Adam, would you say this is more of a long-term investment? He has a little bit of a lag.
Well, certainly, Manolis, from the perspective of our royalty program, which is the way we've been able to put deals on the table, is a 7-year fixed term, and it's a fixed cap loan. So the investors like this because they are engaged with the product, service, or cause, rather than a 2-year quick exit strategy. So, I mean, the reasons for the 1-year delay are obvious. They're to make sure it's a long-term capital gain. Okay, but be that as it may, 2 years and out with an 80% return on investment is not what the entrepreneur has in mind. He's looking to convert the people that he exists to serve into a funding organization first, and then a evangelical sales organization after the raise. And because of the revenue share these folks get, this is just one way of liquidity after the raise, he's able to count on their support and them growing revenue because they've got skin in the game. And we tell everybody up front, this is a 7-year plan, and they're fine with that. And you mentioned social entrepreneurship. Our program caters to the investor. Obviously, he gets the reward or he gets the protection that we offer. But the investor, the entrepreneur, he has to look at the reality that 30% of the money he makes to do whatever he's going to do has to come from family, friends, and followers. What a great gift to be able to tell them that to do the important work he's going to do, they can put their money in without risk of loss. If something happens to him or the organization, they will not lose. And particularly for social good projects where the mission is more important than even the ROI is. This is something that resonates well with that kind of investor, and I imagine the other panel will have more to say on that too. Thanks for my chance.
Excellent. Thank you for that, Adam. And Dusty, did you have any commentary on that?
Yeah, back again, from the assumption that you were making, what I heard was long-term investment. It could be 3, 4, 5, 7 years, but there still has to be an exit opportunity and an exit strategy. During that process, there still needs to be transparency. The S1 form, a registration form that shows what the business does, who works there, what they owe, any other vital information. It's amazing that the people who make investments now in the stock market don't read these. They're very important documents. But we'll go back to, and one more other thing. There's 2 types of opportunities in equity crowdfunding. One is a debt, and one is an equity. I purchase stock, it creates value, or it drops out of the bottom and I lose all of my money. That's the equity process. The debt is more like a bond. As a business, I'm going to come in and tell an investor, I will give them, say, 6% return on their investment per year, and then that's just they're going to basically make a 6% return on their investment as like a bond. Then me as a company, when I'm ready to retire that debt, I will buy that stock back, and that keeps me off the 6% or whatever return. That would be the debt equity. I see that being an exit strategy in itself. When you make these purchases, that you have a time limitation on it, that we're going to hold this for 2 years at 6% per year, then the company's going to buy them back out or give them an option to convert it into straight equity, what they would consider a convertible debt. So any way you look at it, those are the 2 types of debts that the Title III offers, but we still have the exit strategy we have to come up with. We have to come up with some way to exchange these instruments.
Absolutely. Now again, Jess, did you have a question that you'd like to ask the panel?
No, I just want to say that it looks like the most important thing right now is for education. Like, if the public does not know what they're looking for or what to ask, none of this it just won't work. So it's really important that maybe there should be some education in place before any of this can actually go forward, or before anyone can actually be allowed to equity crowdfund, because otherwise it could be like a train wreck at one point.
Well, let me say this: there's tons of educational material out there on the SEC board. In fact, you can get links from our site. It tells you about macro caps, nano caps, the valuations, the risk involved. The smaller the company, the different investment strategies. So I think the educational material is already out there. And the crowdfunding portals are responsible for that information, from what I can tell so far in the rules. So I think you're right. I'm in agreement with you, but I think it's there. We just pointing to that.
As far as people actually reading it, maybe there should be some sort of certification in order to pass some way in order to crowdfund, you know?
Let me jump in for a second, because I think this is one of those areas that's kind of right up my alley. What I love about this discussion is that everyone is saying the same thing. We need to educate the investor. We need to teach them what to do. If all of us have read the 585 pages of the SEC's proposed rules. I'm an attorney. I've been an attorney for 25 years. I can't understand parts of it. It's crazy. Now, you take that to the average Joe on the street, they're not even going to look at this stuff. This educational material that needs to be put out there has to be simple, plain English. Listen, I agree. I can go to the SEC's website and read everything that's on there, and I'll understand it. General public who hasn't gone to law school and practiced law and dealt with starting businesses and equity raises for 25 years, their eyes are going to roll up in their head, and they're going to go nuts when they read the first paragraph on the SEC's website because it's not written in plain English. So in order for people to understand the term liquidity, average Joe on the street doesn't know what that means. We're talking about it as though it's just the most average, common thing that people are talking about in a bar over a beer. We need to be able to explain these things to people in a very simple way that they understand. Look, you're buying in a startup business. There's a really good chance you're going to lose all your money. But you know what? You're taking a chance. It's a small amount of money. It's no different than you walking over to the casino or going over and buying a lottery ticket. If it hits, you're going to do great. If a secondary market develops at some point, you're going to be able to sell it. If not, you know what? You threw a little bit of money into it and you're hoping it's going to work out. But you took a chance on something to build a business that you can feel like you're a part of, much like on a Kickstarter or Indiegogo. You can now be one of those people that's pushing it to make it go forward, along as a marketing machine, and then also being an owner. And I think that's the key to where equity crowdfunding is really going to roll in. The real serious people that are going to raise real money for huge businesses are not going to use Title III. They don't need $1 million to start the business. They're going to be using other mechanisms because Title III is not going to work for them. This is going to be the mom and pop business, the little startup who can't get business money somewhere else, someone who's tried to go through venture capital, tried to go through loans, and can't get that $250,000 or $100,000 that they used to be able to get from the bank. Those are the people that are getting this money. Those aren't businesses that in a year or two are multi-million-dollar businesses. Those are startups. They're small businesses that are going to build and build and build, and ultimately may become a Twitter or a Facebook. I mean, Facebook was started in a dorm room. You know, we all know that. Bottom line is, it's got to be something where everyone is educated in a way that plain English teaches them what they need to know.
Absolutely. I 100% agree with that, and in fact, that's what we're trying to do here with Reality Crowd TV, is really to inform Main Street America that this is specifically for the small business. This is specifically for these startup businesses. This is for the community restaurant who's looking to expand into a second location, third location, fourth location. These aren't for huge established corporations. I'm sure some of them will use this mechanism as well. And there is some good things about this law. I know we've been really beating the law down a lot lately, but I'm trying to bring it up to, I'm trying to end the show on an optimistic note. So what I'd like to do is let us all kind of mention what's good about the law, because there are some good things about the law. So we'll start with Dusty. Dusty, what do you like about Title III proposed rules for equity crowdfunding?
Well, we also have other business models too. We're in digital property, so let's take our widget company. And for me to get out and get 1,000 investors at say $2,000 versus one venture capitalist that wants to come in and basically dominate us for the same amount of investment, that would be that's the whole concept behind the in my opinion, around the entrepreneurial crowdfunding opportunities. And when it comes back to the risk factors, we're now allowing Common Joe to put in, what, maybe $2,000 a year. And I don't know if you were on Facebook, one of the investors made 170,000% return on his money. That was 170,000%. So we have to know it's like the double zero, the greens on the roulette table. I've got a chance to hit that one and to make 36 times my investment. So again, I don't think we would expect someone to spend a lot of time drooling over S1 forms, registration forms, if all they were to put in was maybe $2,000, which we've limited it to at this point. So I think it's a win-win situation. I think the investor that wants to come in and see a widget company that they feel like will hit big, they can put in what they want and they can watch that company grow, as long as we can offer them some type of exit strategy or opportunity to purchase and get more, if that helps.
Thanks. And then we'll go to Adam. Adam, what do you like about these laws, these Title III equity crowdfunding laws?
Together with other laws that are out there, that's the important part. What we're seeing is a democratization of the capital formation process. And this benefits the entrepreneur in that he's able to reach the people he was destined to serve instead of having two masters, those for which he's making a great product, service, or cause, and then those who are only in it for the money, the speculative investor type. From the perspective of the investor, with the help of a risk reduction mechanism like CR cover or what will mature into an entire marketplace of such risk reduction tools, the self-directed IRA is just one thing we've been talking about as a way to get people back in control of their retirement funds. The old model isn't working for them. When your, quote, savings account is losing 6% per year, something has to change. And so it isn't just the new crowdfunding law. It's an entire change in the way certain people in government and in industry are thinking about the benefits of crowdsourcing the financing, the development, the distribution, and the consumption of products around the world, products and services around the world. And this is just a small part of it. I'm so excited to be a part of it and champion you guys for taking what Kendall rightly pointed out as incredibly obtuse information and rendering it for the YouTube generation to be able to digest it and make good use of it and make that the dream of the Jobs Act a reality.
Absolutely, and that's a good point that you made, Adam. Although the laws are complicated, although the laws have compliance and regulation, although all these things are what we're trying to inform and educate people who are watching this right now, these are not reasons for someone to give up. I mean, what I'm hoping doesn't happen is that someone hears about this and then suddenly they say, oh, well, that's not going to work for me, because all too often people do that when they hear that it might be a couple of obstacles in the way. But what entrepreneurs realize is if they're getting declined by a bank, if they're getting declined by venture capitalists, they now have a third source of funding, which is really the American public. And that is a huge resource. So if that third option is the only viable option, then you're going to need to jump through the hoops and actually go ahead and do this, because otherwise you will just let your dream fall to the wayside. And I don't think that's what an entrepreneur does. If someone's truly committed to something, they will find a way in one of those three avenues and the royalty model, as you mentioned. But these are just obstacles that are just standard practice when you're an entrepreneur. You bump up against one way, you find a different direction. You bump up again, you keep going until you find it. So I'm gonna leave the final real comment for Kendall, because what do you like, Kendall? What do you like about these new laws?
I love Title III. I love the law. I think the 9 pages that Congress wrote with a couple of little minor tweaks is a phenomenal, wonderful law that could change the way small businesses are started and could just put entrepreneurs back in the game to get back in the American dream. Before 2008, these same people would go to the bank and say, hey, I've got a great idea. Can you lend me 50 grand or 100 grand? And the banks would say, sure. And that's how people started their businesses. When the banks stopped lending, there's a funding gap. Getting that first $1 million is almost impossible today because venture capitalists aren't playing in that world anymore, especially with startups. Angels very rarely want to lead a startup at the very beginning of the process. So you're either looking at your own bank account, friends and family, or equity crowdfunding, which is coming. I love the law. I hate what the SEC did with the law. They made it incredibly complicated. They added regulation upon regulation. They added compliance issue upon compliance issue. And they made it so that to raise $100,000, an entrepreneur is going to have to spend $15,000 or $20,000 or $25,000. No one's going to be able to do it the way the SEC has set it out because it's too expensive and too complex. We started FundHub to give people a way that they can do it simply, come on our site, fill out simple forms to get all the compliance done for a small fraction of what a law firm would charge to do it. But the fact of the matter is, it's still a complicated process. And Manolis, you hit the nail on the head. Listen, I'm an entrepreneur. I've started and run many, many, many businesses. I've helped, as a lawyer, many, many people start and run businesses throughout the years, 25 years of doing this. I'm not going to get stopped by the complexity of a law, and most entrepreneurs aren't going to let that happen either. But the fact of the matter is, the Jobs Act, the law, those 9 pages are great. Those 585 pages proposed by the SEC are horrific, and they're going to make some changes. If you read the public comments that are on the SEC site, I submitted one, many people have, they're going to make some changes. They're going to have to simplify it, because otherwise it's not going to get used at all. It's going to sit on the shelves and be completely useless the way that it's written. Very few people are going to be able to afford to do it, and there are other ways to do what they're proposing to do, cheaper and easier and less stressful for an entrepreneur. So SEC needs to fix what's up there. The Jobs Act is a great law. I love it. It's the wonderful thing, but it's got to be simplified by the SEC.
Absolutely. And actually, Jessica, do you have one more question or comment before we sign off for the evening?
No, I just want to say that I also really believe in this equity crowdfunding rule, and that it will open up so many opportunities, so don't get discouraged by some of the things that we've been saying, because in the long run, hopefully, this will get corrected and the education behind it will come, so we can beat those obstacles.
You know, Jessica, one more quick point, because I think that's a great point. Even if the SEC doesn't fix these rules, we have another solution. We have congressmen. We have the people who passed this law by an overwhelming majority, bipartisan support. If the SEC makes it too complicated, next legislative session, we can all go up there and talk to our congresspeople and say, you know what, you need to fix these things that the SEC screwed up, and it can be fixed. It may take a year, but it can get done.
Absolutely.
I'd like to add one other thing.
Yes, Dustin. All right.
We don't need to reinvent the wheel at all. Everything is in place, the forms, the procedures. All we need to do is to dial them down and not make it necessary for an entrepreneur to have to pay $250 an hour to some attorney to draw these papers up. To fill out an S1 form to register your company as a reporting company, 10 reporting company is really not that much work. It can be done for $5,000–$10,000 versus the $40,000. So again, we don't have to reinvent the wheel. Just take the forms that are currently in process, put a CF for crowdfunding, and don't make them so hard to get to and to create, and make them transparent, make them where people can see them.
Absolutely. So panelists, thank you all very much, and for the audience out there, thank you as well for sticking with us. Next Thursday, we're actually going to be returning back to rewards-based crowdfunding. Our last 2 episodes focused on equity-based crowdfunding because this is something that most people do not know about. They may have heard of rewards-based crowdfunding, but they've never really seen the equity side of the equation that's currently being deliberated through the SEC. So once again, everyone, thank you all for coming, and until next time, dream it, believe it, achieve it. Thank you all. Have a good night.
Thank you.
Thank you.